Now, before we move on to our next theme, which is macroeconomics, we have a short film for you that maps out some of the challenges ahead. Take a look. For this next roundtable, we'll talk about the new and sometimes conflicting currents driving decisions by central banks and states, as well as the overall economic climate. As we just heard, it's a complex landscape and one that will be and will remain for some time difficult to navigate. So let's have our guests on stage. And there again, please give them a warm welcome. Thank you. Welcome to all of you. Thank you for joining us this afternoon. I'm joined by Professor Ricardo Reis. You are A.W. Phillips Professor of Economics at the London School of Economics. We also have Professor Keyu, Professor of Economics, also at the LSE, the London School of Economics, of course. And Dr. Adam Posen, you are President of the Peterson Institute for International Economics. We're delighted to have you with us this afternoon. Many topics to discuss, and sadly, very little time. So let me start with you, Professor Ricardo Reis. Recent events have shown that the global and economic, political environment is driving higher fragmentation risks. So can you give us your view on what this means for long-term interest rates?
Look, we spent the last 20 years trying to make sense of why interest rates on government bonds fell. And aside from demographics, there were really three big culprits behind that fall. First, the large current account deficits from China and the rest of Asia, leading to a large flow of capital towards Europe and the US that went mostly to treasuries and bonds. Second, that we had a stagnation of investment here with very few investment opportunities in the 2010s especially. And third, that government bonds were seen as very safe. They wouldn't default. There was not much of an inflation risk after the stability of inflation. And that's why we understood why it was at that. There was such a saving demand for government bonds pushing those interest rates down. Having gone through these 3 points, which again was a literature of 20 years, what's happened in the last 3 years? All three of them have reverted. China already for a few years, and as well as Southeast Asia as a whole, moved to current account, closer to a current account balance. And even when a deficit rises now, shifting its savings not towards treasuries, but rather towards commodities and others. Second, we're having an investment boom, both the good side, if you want, with AI, as well as in terms of industrial policy. We just heard Minister Marine talk about the investments in defense. And third, boy, for all the investors here who believed in the safety of government bonds, you just had a rude awakening when it came to inflation eroding the value of those bonds. Combine all those together, and you have that the long-term interest rates are surely much higher than they were, that some of the fall of the last 20 years has been undone. And so looking ahead, I would say that US interest rates, a new normal is some number between 4 and 5%. European interest rates, say for the Bund, a new normal is at 2.5 to 3.5%.
Thank you very much. We're now moving on to the thorny topic of public debt, of course, with you, Dr. Adam Posen. In the US, the Congressional Budget Office now projects that public debt will rise to 116% of GDP by 2034, you have heard well, and reach 172% by 2054. They are unprecedented figures, of course. So how worried should investors be at these projections? And do you think that markets will eventually force an adjustment?
Thank you to Amundi for having me and letting me join my distinguished colleagues here. I think you should always take any long-term projections with a very big grain of salt. I came up in this profession around 2000 when people were projecting surpluses for the US as far as the eye could see, and Alan Greenspan was worrying about what are we going to do if we have no government debt issued. So just be careful. But the direct implication of that, I think, for this audience and for most people, is that the flow rather than the stock is actually of much more concern. It's less about the fact that, yes, we're over 100% of GDP, which is usually a bad sign, but Japan and Belgium have managed somehow to get along with those levels of GDP to debt ratios, debt to GDP ratios. What instead is worrisome is we're now up at levels where the interest payments as a share of US government and a share of US GDP are at historically high levels. They're not quite back to where they were in the mid-'80s, but they are back to where they were in, say, 1998. And so you've got a lot of issuance. They're emphasizing short-term issuance. So you have two competing issues. One, which I completely agree with Ricardo on, that the long-term rate is fundamentally up. That what we call R star, which is proxied by the 10-year safe bond rate, is being driven up by these long-term factors. We might get lucky and get a productivity gain from AI or something, and that also, though, would raise interest rates. At the same time, in a geopolitically fragmented world, as you were just talking about, I think there's much more pressure for people to invest in the US, either by force, because the US has its various threats of secondary sanctions and restrictions, or by other means that people get scared. And even if the US is making the world more unsafe, as it in some ways does, you still feel safer about your assets in the US than other places. So no, I don't think markets are going to do a correction, but yes, I think markets are going to maintain upward pressure on long rates for the next several years.
Thank you very much. Professor Jin, let's talk about China now. Given the country's lower growth trajectory for the medium term, the government is seeking to develop new growth engines. Notably, it's moving away from high public investment and the property sector, while turning towards technology and innovation. So how difficult do you think this shift will be, and how can China incentivize private investment in the new sectors? And another question, if these new growth paths do not work, then what happens, and how will the rest of Asia fare?
Well, first of all, the Chinese government likes to think about the long term when some of the issues are really short term. So when you try to say, deal with a real estate transition in 3 years rather than 10 years, and you're going to say, well, the alternative growth model is based on renewables and new tech and high tech and spend all the resources on that, you're betting for the very long term. Look, the real estate is simply so big that it's really hard to be displaced by investments in renewables and things like that. So I think the short term in the transition, it is rather painful, and I think that's what the country is going through. But I think some of this misunderstanding is whether we think that China has a structural problem, a permanent kind of problem, or a cyclical problem. U.S. has had many recessions, official recessions in the last few decades. This arguably is China's first big one. So this natural boom and bust is also, part of the economy, part of the natural market economy. So I think the Chinese government believes that China really needs to restructure and transition into higher value added, higher technology. But the real problem is there's still almost 1 billion people who lives under $300 a month. Vast number of undereducated, underemployed people. And the gap, convergence with the US or even within China, the massive heterogeneity across the provinces and the cities goes to show that the potential is there. If you talk about long-run potential in China, given the saving rate, education, domestic capacity, innovate, should have a pretty good potential. But in the short term, they're not focusing on stimulating demand because they think it's going after things like high tech, renewable technology that will, really make China technologically independent and so focus a lot on the transition. Whereas I think a lot of the problems are also just short-term confidence-based.
Thank you very much. What's also going to dictate the macroeconomic climate, of course, is the outcome of the elections in the US. So Dr. Posen, what major differences between the Biden and Trump agendas should investors be aware of? And regardless of who is going to become president, what consequences do you see for the US economy if the trend towards greater protectionism persists?
I think there are very profound differences between Trump and Biden, what they would each do with their second term. Unfortunately, on protectionism and relations with China, there isn't that much difference. I think we've already seen that once you put in tariffs, it's very hard politically to roll them back, and Biden doesn't entirely want to. And we've seen Biden now make announcements about doing things at the southern border with Mexico, partly for show, but partly real, to keep up with Trump. I do think on that front, the Trump administration would be much more aggressive than people realize about actively deporting people from the US. I was just speaking with someone who sort of speaks for Trump. Nobody really speaks for Trump, but sort of speaks for Trump. I'm not even sure Trump speaks for Trump, but that's... but they're talking about numbers on the order of 1 to 1.5 million deportations. And this is an extraordinary number, but just so you understand, in the 1950s, the Eisenhower administration did something with the unfortunate name Operation Wetback, and they deported over 1 million Mexican workers in the US at that time. So this is not unprecedented, and it would be incredibly disruptive to particular sectors, particular regions in the US. More broadly, I think the other piece you should look at are fiscal and foreign policy, which have direct macroeconomic implications. On the fiscal side, both of them are going to be confronted with the expiry of the set of tax cuts and changes that were passed in 2017. There is only one instance in the last 80 years where expiring tax cuts were not replaced immediately with some form of continuation. So you should expect that they will be replaced. I do think Trump being more protectionist would get more revenues from tariffs. And so the net position initially would be a little more disciplined under Trump than under Biden. But I actually think you're going to get a boom-bust scenario under Trump because there would be a rotation away from the green investment into internal combustion engines, drill, baby drill, fossil fuel extraction, as well as a de facto deregulation of many industries. And this is something the president can all do by executive order, irrespective of Congress. And I think in the short term, that will be pro-growth, slightly close the deficits, not close them, slightly close them. But it will not be stable, and it will lead to further dollar overvaluation and other potential issues. Finally, and I know we're short of time, just the effects of a Trump presidency are much worse on the rest of the world than the US. A withdrawal from NATO, a disruption of trade, what that does to developing countries, escalating conflicts with China. This is all bad for growth in the rest of the world more than in the US.
Thank you very much. We're going to move to monetary policy now with you, Ricardo Reis. Since you were one of the few to flag the risk of inflation rising above central bank targets, you also said, I will quote you here, central banks should balance bringing inflation down with not breaking things. It's never been easy to be a central banker, but certainly not getting easier, right? So are central banks succeeding, and should investors worry about the last mile or a re-acceleration of inflation? And what are the things that central banks should avoid breaking?
I think we're already in July, and if you look at pretty much any forecast, and the strong indication from the data is that whether it is the euro area, the UK, or Japan, inflation is going to be less than 3% for this year. For the US, a little more doubtful, around the margin of 3%, maybe a little bit above, but bar any major shock, inflation is going to be well below 3% and fairly close to 2%. That is a great success, and that means that inflation has been beaten. It was only 24 months ago, they were talking about inflation that was in the 2 digits. Or now if we're talking about, well, I would like it to be 2.2 instead of 2.6, that's normal, that's back to the world of 2% inflation, and it's important to make that distinction. Moreover, central banks and monetary policy are ultimately the key drivers of inflation, and over the last 2 years, we've seen extremely determined central banking when it came to hiking rates and keeping inflation under control. I think back in 2021, for a few months, we saw a lot of, let's say, hesitation from central banks for doing what needed to be done, and they may have contributed in part to some of the problems that we had. But the fact is, over the last years, and it was not easy, they have hiked extremely aggressively. I mean, I testified in the European Parliament in the early 2021, and raising rates to 0, I was told by several parliamentarians, would bring fascism back to Europe. It was going to be the end of the world. Now, the politics are looking a little scary in Europe. This is the right place to say it. But I don't think it was the hiking of interest rates of the ECB that caused that in any kind of way. So I think optimism on inflation, and especially central banks, that if you look in the last 6 months when we had some little fluttering of inflation, immediately they were not making mistakes that they would have done 3 years ago and were quick to hike. Having said that, looking at that very benevolent, optimistic path for inflation, there are some upside risks. Or better, I say there are more upside than downside risks. Focusing only on the euro area in the interest of time, I think the challenge in the euro area is that we have a healthy, a sensible, a desirable catching up of wages given the losses due to inflation in the last 2 years. But it's a catching up to an unknown target. And an unknown target, why? Because of the invasion of Ukraine, the change in energy prices, the geopolitical considerations, and the many shocks that Adam was speaking about, what we have is that we don't really know what wages in Europe should be relative to productivity. And as a result, are the wages that we're seeing already excessive and part of a wage price dynamics of high inflation or not, is something that we're determining in real time in the data. So that's, I think, the source of uncertainty, and that points perhaps to an upside risk. But overall, I think inflation is solidly going towards the 2–2.5% range.
Thank you very much. Unfortunately, we need to wrap up this conversation, but not before I ask you the following questions. Dr. Jin, we've talked about China getting into high potential, high growth sectors like clean tech, for instance, and energy. And clearly the country has a strong competitive advantage in EVs and solar panels, for instance. But they are facing increasing protectionism. So how can China expand these sectors while also participating in and benefiting from global trade, and especially as advancing green tech and addressing climate change also become priorities for the country?
Well, first of all of these sectors are deeply embedded in a global supply chain. China is only one part of it. And China, whether it's in batteries, renewables, solar, EVs, are just one participant of many. And they want to work with especially European countries and companies to further that. And so I worry about two things. One is, the green transition. If China had spent so much money, but a lot of it is also just based on the scale, the learning, all these pilot cities like EVs, from 13 pilot cities to 80 pilot cities, all the costs that they've incurred, the demand subsidies, they've come up with really competitive products, something global, and this is about global trade. You export in which you have comparative advantage. You don't do everything yourself, right? So I worry about the green transition when it comes to adoption of these, the potential and accessibility of these low-cost, good technology Chinese renewables. And the second is I also worry about Chinese reactions, right? In fact, when you're talking about EVs, well, the Shanghainese government also subsidized Tesla in making cars in China. So I worry about the rising protectionism, the rising industrial policy, competition, rising industrial policies, and also in terms of European trade with China, how is China going to react? So I think we're going down a very dangerous route. It's very important to invest heavily in these new sectors for the green transition, and this is what's missing in many countries, especially emerging countries. So we shouldn't be, slowing down in that front.
So we've talked about China a lot, but what about the other powerhouse emerging in Asia? It's India, of course, and that's the opportunity for me to tease the next roundtable, which will all be about India. What role do you see for India within the regional and global economy?
Well, first thing is this year and expected next year, and probably in the next few years, the 3 fastest growing economies in the world are all in Asia. India, China, Indonesia. And if you think about 50% of the middle income living in Asia, 50% of the millennials, the numbers are huge. But obviously, Asia is very, very diverse in different phases, in different demographic situations. And so if you look at India, of course, a lot of excitement going on, huge amount of investment in infrastructure, hugely, demographic dividend. Again, I want to come back to this point about convergence. Just like, China has room to converge with other richer countries, India has a huge amount of room to converge with China. If you look at just manufacturing capacity, India is what, 10%, less than 10% of China's Chinese industrial manufacturing, in terms of human capital, education. There's a long way to go. So if you roughly go down the route of China's development path, I think that means a great potential. But then, of course, the political systems are very different. As we know, China had very strong state capacity, and all of that, of course, is it's a unique development path for India.
Thank you very much. That's all we have time for, I'm afraid. Thank you. And like I've mentioned, next we're going to talk about India, whose recent elections confirm its title as the world's most populous democracy. But as our next guests make their way to the stage, I'd like to thank you all for your great contribution to this conversation today. Thank you very much. Ricardo, Reis, Keyu, and Adam Posen. Thank you.